Our part 2 starts at the solvency ratios. So we're looking at firstly the firm's capital structure, and we're looking at what percentage is equity versus debt, because the higher the debt, the more risky the company is, and that distinguishes whether we're able to pay off the long-term obligations or not. If you don't have any long-term obligations, which means you don't have debt in your capital structure, then your profitability is not really a concern. It's more concern for your shareholders as to how well are you performing to be able to get them dividends. The first two ratios we're looking at is the debt to equity ratio. Your debt to equity ratio, remember, takes into consideration everything we term as debt. So we want you to take both the current and non-current liabilities together if they are split, and look at the total liabilities, and then to divide that as a percentage of your total equity. And within total equity, you're taking the total equity of the business. So this includes then your retained earnings, and it includes your share capital and share premium. So whenever you're looking at the total equity, we're not just looking at one line item called share capital and share premium. We remember the retained earnings belongs to the equity, the shareholders of the business. So you need to incorporate that in the retained earnings. So total debt divided by total equity, that tells me, okay, if I've got a higher percentage, it means I'm increasing the amount of debt in that business. So if I were to look at ShopRite's here, which I've computed here on the right, ShopRite's debt to equity has gone from 3 to around 3.3. They've increased the amount of total debt that they're using within their capital structure. Maybe they were targeting 3 and maybe the industry norm is 3. So in this instance, in 2020, we'd be saying that the amount of leverage that then ShopRite has taken upon is maybe a bit too extreme in terms of their total liabilities, and they need to now look at ways to scale back and maybe pay off with their cash, because they've got quite a bit of cash on their balance sheet. Instead of investing some of that cash in their inventory the following period, maybe they look to pay off some of their liabilities that they have. If I were to look at ShopRite's financial statements, a large portion of this debt to equity is actually sitting in lease liabilities. So they have a lot of lease liabilities that they have in place. Maybe they pay off some of these lease liabilities going forward to not have that much debt on their balance sheet. Okay, what I've also done here is calculate a borrowings to equity. Borrowings only looks at your long-term debt. So it excludes any like accounts payable balances. It excludes any like current liabilities. If you've got, let's say, deferred income, it specifically only looks at what are my long-term borrowings within the business. So any long-term facilities. So in this instance, I would have only included the lease liabilities and in any sort of long-term debt or term loans. And I multiplied that as a percentage of equity. And you can see they're a little bit much smaller. So a huge part of the ShopRite balance sheet is actually your accounts payable balance as well, because they take some of your inventory on account, and that actually inflates your total debt to your total equity. Okay, now looking at debt ratio. Debt ratio, remember, when we're doing our common size financial statements, every single line item was divided as a percentage of assets. So you need to be careful. When they say debt ratio, they don't have to say debt to assets, but you should pick up that whenever they're saying just a normal debt ratio, of course you can't just put the debt amount there. It must be as a percentage of total assets. So here, if I look at the percentage of total assets, quite a significant portion of this business is funded by debt facilities and not equity. So as a percentage of the total assets that sit at 100, you have 25% in equity and 75%. So quite a big amount is leveraged. Okay. And what has happened from 2019 to 2020, we have increased our debt. So similar, the debt ratio tells you the same thing as your debt to equity ratio. What it does say is that we've increased the amount of leverage on the balance sheet. My debt to equity has gone up and my debt ratio has also increased. Okay. One of the ratios that a lot of people struggle with is actually not the debt to equity or the debt ratio, it's the equity multiplier. Reason being is the actual name seems very complicated and we're looking at equity and we're looking at a multiplier, but it's actually quite easy to calculate. Remember, all three things are saying the same thing. Now, when we're looking at the equity multiplier, we're saying that you've got assets that you funded from your business, and those assets were either funded, remember, from your equity balance or your debt balance as a denominator. If your assets are funded and you, as a percentage of your equity, your assets are growing, but your equity is getting smaller, which means your actual equity multiplier is getting bigger. So your assets are growing, but they're funded less from equity. That actually means we're increasing leverage over time. So this ratio actually looks at total assets as a percentage of equity, but it also indicates what leverage is in the business, because the remainder of that funding of your assets is coming from debt if it's not coming from equity. So if you notice, all three ratios are increasing. So not that one, the debt ratio, debt to equity, and our equity multiplier. In each of these three ratios, we've used the accounting equation, assets is equal to liabilities plus equity. The first ratio, we just took debt and equity. Second ratio, we took debt and assets. Third ratio, you're taking assets and equity. So all three ratios are talking to the same thing. We've increased our leverage in this business from 2019 to 2020. And whenever they go up, it's an increase in gearing, an increase in more financial risk. If I look at borrowing specifically, borrowing seems to have remained stable. So we're not really increasing our long-term borrowings. It's mostly coming from our facilities. So if I were to probably drill down into ShopRite's financial statements, probably there's been a huge pickup in the accounts payable balance. So we've taken longer to pay off our suppliers. That filters through to your total liabilities, which comes through in your debt, all these debt calculations. But your long-term facilities, if you look at the borrowings, the other term loans, those have pretty much remained flat. Okay, the last important ratio is your interest cover. Interest cover is important. Why? Interest cover tells you, do I have enough operating profits to pay off then that interest that becomes due every single year? Remember, you've got interest payments that you are paying. You're either paying these interest payments maybe quarterly, you're paying them annually, or you're paying them semi-annually. But do I have enough money that I've generated? And the money that you're looking at, remember, your operating profit needs to be before your interest in your tax calculation. Just pure profit that we've actually generated before having to pay off interest and tax. Is my business doing well to pay off then that interest calculation? So the trick here with your interest cover, remember, it needs to use EBIT. You cannot use profit after tax. You need to use EBIT in the calculation as a percentage of interest. Moving on to your profitability ratios. I said to you guys, your profitability ratios you can pick up from your common size financial statements. So you'll notice the first two profitability ratios are literally just your, these would appear in your common size financial statements. You'd either look at your gross profit line, you look at your operating profit line, and whenever you see margin, it just means as a percentage of sales. So with your gross profit, we've said gross profit divided by sales. We've also looked at your net profit as a percentage of sales. Both margins are increasing, which is a good sign for this business. It means it's being able to generate a higher net profit as a percentage of sales and a higher gross profit. They were basically able to pass off your cost of sales and increase the amount of sales to the customers without having increased the amount of cost of goods that came into the business. So what it means is, if your gross profit is increasing, my gross profit, I've managed to mark up a lot of my goods by a higher percentage without actually impacting on the cost of goods that I've actually managed to get in the business. A good sign. Net profit margin's also gone up. It could either be as a result of your operating expenses being low, but you'd need to look further into the drill down of your income statement. Okay, then we've got, I said to you, we'll have a look at not just your return on sales. We'll now then also combine your returns now as a percentage of a balance sheet item, which is now your assets balance. So the first one we're looking at here is your return on assets. You're taking the net profit that you've gotten for that entire year and dividing it as a percentage of total assets. We'll notice that also your net profit as a percentage of assets has also increased. So you didn't have to go invest in as many assets this year, but you were able to generate a higher net profit in 2020 than in 2019. Okay, your return on assets, am I getting a reasonable return given the amount of assets that I've invested in my business? Okay, return on total capital is a little bit different. Why is return on total capital different? Similar to what we're using with interest cover. In this instance, we are using EBIT and we are not using profit after tax. So here you've used profit after tax. Whenever you see total capital or interest cover, we're using EBIT. So we want to take it before your funding costs. Your funding costs are, your interest payments is part of your funding costs. So we want to see what are the returns before my funding costs, because my total capital is going back to my debt and my shareholders, but I want to see it before that funding, that profit that I've been able to make. Okay, that's also gone up, which is a good sign for ShopRite. Your return on equity ultimately, which is your net profit after tax as a percentage of equity, has also gone up. Okay, so all these ratios become extremely important. Remember, your total capital uses debt and equity. Another way of looking at debt and equity, because I said your debt and equity balance as part of the accounting equation. If you don't have the total debt and total equity and they have given you total assets, you are able to use total assets here. Technically speaking, it should only be the stockholders' equity, but we are using the total equity for exam purposes. Okay, last ratios we'll be covering will be your activity ratios and your long-term activity ratios. Your activity ratios are looking at each of the three different current assets and current liabilities lines. So you're looking at your inventory, I'm looking at my trade receivables, and I'm looking at my trade payables. The first thing I want to calculate is the turnover. So whenever you're looking at turnover, I want to look at what income statement line does that account refer to. Inventory and payables both use cost of sales. Receivables uses sales. Why does inventory and payables? Remember, for your balance sheet, your stock comes through as an inventory balance, then becomes cost of sales when you sell it. Your payables as well, you're using that percentage of your facility to determine what cost of sales comes through into your income statement. So inventory and payables, your line item that you're looking at in that instance is your cost of sales. Because we are looking at ShopRite's half-year financial statements, what I have done in that instance is multiplied the cost of sales or the sales amount by 2 to get a full annual figure, and then multiplied that by the average payables and the average inventory. This is what I actually get to. Okay, your receivables, I took sales, so I took your sales amount multiplied by 2 to try and get an annual sales figure because it was a 6-month figure that I was using. I then took my receivables balance and also for each year and divided that by 2. So remember, for your activity ratios, I want you to use average balances. I haven't said in all the other ratios you need to use average balances, but for your activity specifically, because it impacts on your days that you're calculating, I want you to use the average balance. Okay, when you're now looking at the days calculation, all you're doing for all three is taking 365 divided by the turnover that you've calculated, and then that gives you the days. Okay, you've taken 74 days to pay off your suppliers, 10 days to receive money from your customers, and 60 days for your inventory to go throughout your balance. It went from 67 days. This is a huge improvement on your inventory line. Your inventory is not slow moving, which is a very good sign. Okay, last few two ratios that we're covering is just an easy ratio. We're looking at here fixed assets. So your long-term activity ratios we're looking at are your fixed assets. And that is quite quickly. So I just covered the short-term activity. 1 second. The long-term activity is just your sales divided by your fixed assets, and your sales divided by your total assets. So within your long-term activity, we are still looking at your sales, but each time you're dividing it either by the fixed assets or the total assets line item. Okay, quite self-explanatory. If these sales as a percentage of fixed assets has gone up, it's a good sign we're able to generate more sales, even though our investment in assets has been a lot smaller. Or if your sales as a percentage of total assets has also gone up, this is also a good sign. These are just indicate your long-term activity ratios that you've come about. Okay. If you also want to then calculate it as days, 365 divided by that will give you then the days calculation. All right, that's it from my side. What I'll do is in the next ratio, I'll also cover DuPont. Thanks, guys.